I want to welcome every single one of you on this call tonight. We have a very important topic of modern concern for all retail traders, especially those who strive for mastery and 21st century understanding of market movements. It is no longer a new thing when you mention the inner circle traders, ICT, to people or anyone. There are 7 major institutional reference points. These areas are where the market makers, the liquidity providers, always manipulate the market to be able to take advantage and to be able to move in the way that they move. This was discovered by the legendary So we are going to be looking at these 7 institutional reference points of the legendary ICT. But before we go ahead, I want to be very sure that everybody on this call can actually see me and hear me. And I want to also very quickly welcome every one of you, thank you, on this call tonight. Today is, I think I lost count, 17, 18, 19. Today is day 20, I guess. I think day 20. Today is day 20 of our call. And those of you on the YouTube, we have the subscription button right below this video. Kindly subscribe to this channel, James Ochima, if today is your first time. And those of you who are already subscribed to my channel and you have always watched what we've been doing, today is day 20. Right from day 1, when we started on the 16th of December, we have been taking it one after the other, breaking it down, taking people from zero knowledge to professional level where they can navigate this market in the best way possible. The first institutional reference point of the ICT, that's inner circle trader, number 1 is breaker block. So write it down. Breaker block is a very important reference point for the ICT. You need to know what breaker block means. Permit me to also give it another name for easy understanding: failed order block. So you will later find out or know what order block is. And when it fails, it becomes a breaker block. The second institutional reference point for ICT, please, I'm so sorry for, I think I'm having a glitch off and on. Let me see if I can just fix that once and for all. Okay. The second institutional reference point for ICT, which we are going to be looking at, talking about it today, and explaining it as much as possible via practical examples, is a mitigation block. Write it down. Mitigation block. Mitigation block, I'll give it another name for easy understanding. It's called a failed swing. So our goal is not just to know them. Our goal is to be able to find them in the market, and not just find them as many times as possible, is to master them and begin to use them to enter the market or exit the market, or to understand the movements of the market. The third one is called the liquidity void. Void is simply another word for gap. So permit me to just say gap, or let me use an S, gaps. So you get to always remember easily when we give it another name. Number 4 institutional reference point of the inner circle trader is what we call the fair value gap. The fair value gap is an economic language word and popularly known as FVG. So you hear it a lot of times, FVG. The fifth institutional reference point is the order block. The order block is the fifth institutional reference point we are going to be looking at. And permit me to give it a second name, which is also popular known as OB. The sixth institutional reference point, please write it down. Ensure you are writing it down. Be very, very important so that you will be able to identify them one after the other as many times as possible in the market. And also remember that the goal is not just to understand them, but how to use them to trade the markets. So I think I'll write weeks. I'll write weeks. Or rejection weeks. The seventh one, in no particular order, of course, is the old high. Let me use the low first because I prefer that low. Old lows slash old highs. There is no other name for that. It's just old highs or old lows. These are the 7 institutional reference points of the ICT. We are going to first of all now start by drawing them for you to understand them one after the other. Starting from the first one we have on our list here, the breaker block. So if we have a situation in the market where price was dropping down, then price began to go up but form a lower high. Then price goes down to form a lower low, which gives us an idea that the market is trending downwards. Then all of a sudden, we now notice that market change is called market structure shifts. Normally, it's supposed to continue by forming lower low and going downward. But if the market change direction and give you a market structure shift, after showing you a move to the downside, it now show you a market structure shift. You notice an MSS. When that happens, if the price pulls back to this area where the market shifted, that area is the area of the breaker block. So when we have a breaker block, the most important part of this breaker block is this area. What happens in this area? Most of the time, we expect the market to shoot up from the breaker block area. So this is what we know as breaker block, this situation. Usually, permit me to get now, there is a particular green candle here. Is it green now? We say the candle that is going upwards, that was here, or even sometimes red candle, the biggest candle here, the last candle that was printed before this price dropped down is very important. Now, also very important to note is that there was, because now past tense, there was a break of structure, BOS. There was a break of structure here when the price moved, formed an order block here, because it takes an order block here. Permit me where I use this yellow line. Maybe I should use a red, right? Let me use red so that it will be making more sense. Price drop, form a low, goes back up, forms a high, but a lower high, Then a red candle, the last red candle that was printed before the price dashed down to this place. According to one of my friends, Steve, he said, this candle that was responsible for this damage, you mark this candle. You mark this candle that was responsible for that damage that brought the price to the downside, on the condition that this candle that brought this price to the downside, that the market came back and ran over the candle and went high, close above. If there is a pullback, we want to pay attention to that pullback in this area. This area, this yellow area, is called the breaker block area. We want to look for an entry at this breaker block area, and we want to ride it to the top. Our SL is going to be halfway of that move, 50% of that move. And in our Fibonacci class, we learned that below 61 Fibonacci percent area, because it's a push, a pullback, is where we have our stop loss. Then in another of that class, we also were told that another stop loss will be the low of that swing, which is the best stop loss area, the low of that swing. So if that is done, or if that is noted, the last thing you want to check now is, remember that this has to be done on H4 time frame. You know, you want to find these things on H4 time frame or on D1 time frame, because when you find it at any of these time frames, you go down around smaller time frame M15, M30, and you look for a nice entry based on M15, M30. The market moves a little bit from here, even up to this TP1 area. TP1 area is this first swing here. The price move from where it is to this TP1 area. It's a very good profit if you look for entry on a smaller time frame. Now, to explain what I'm saying better, I'll look for what I've said so far. This is it. We have a situation here on weekly time frame where the price was trending downwards like this. From here to this low, went up from a lower high. There is a red candle here that was responsible for all this push. Rest a little bit, but continue downward and form this push. So giving us that impression that we are bearish. 1, 2, 3. Break of structure to the downside. All of a sudden, we saw price go back. We don't expect price to go above this order block anymore. So we mark that order block. We expect price to push from here, then continue down, or push here, down. But when we see price go and break above, close above here, this candle, bullish engulfing candle, show that price has closed above this order block. So above this order block that was principal for the downward push. So from here, we now know that we have a failed order block. The order block has failed to push the price downward. So price closed above the order block. When that happens, what we expect now is a breaker block. It means that the price now, what happens there is that the price has formed a breaker block. So what we are looking for after the breaker block has been formed is lower time frame. So let me go down again more to look for more examples where I can show you where we had a breaker block. This is a daily time frame, so I'm sure you can see clearly too. If you look this way, if I change maybe to line chart, you would see it clearly. You see it clearly. Here, this one. So looking at the price dropping from here to this level, to this level, to this level, that's a sign of a bearish movement on a daily time frame. All of a sudden, we saw price going up, break above. break above here. So that makes this place a breaker block. So when price comes back to a breaker block, we expect price to react to that breaker block. So if you see what happened here, if you go back to the candles, you will notice that we had a nice reaction from the breaker block area. Breaker block was formed here, price break here. When price came back to the breaker block, see the movement. This is daily candle, remember. So if you catch from here to here, how many pips are we talking about? We're talking about 87 pips. But if you catch from here to here, double bottom, how many pips are we talking about? 142 pips. So you see, easily you can find 80 pips, 100 pips with just a breaker block, understanding what a breaker block is. So if we go back now to the candle chart, you appreciate all that I've said better. So the price was going down, formed a low here, properly in the swing, formed a high here. This red candle, if you look carefully and closely, this red candle that was responsible for break of structure to the downside. Break of structure to the downside, BOS. This is a BOS here. This red candle was responsible for this break of this structure to the downside. So after a break of structure, we expect that price just go up and continue going down. But no, price did not do that. Price went up and violated this other block. This red candle is the other block. We mark the other block. And price went as far as breaking above the other block with this candle. When price breaks away from the other block, we mark this place as breaker block. We wait for price to come back again. Any day price come back again to the breaker block area, we expect the price to pick up. So if we have the price coming here, we now have a bullish engulfing H4. Remember what we say, sorry, D1. When we have a bullish engulfing, don't just enter the next candle because we are in higher time frame. You need to wait for price to come back to the lower level, down to the lower level. That brings you down to H4 or M30 or whatever. Let me see where we can get the entry for this asset right now. I wish I got the date. Sorry, just to make it easy for us to remember the dates. This happened on the other, sorry, the what's it called now? The bullish engulfing happened on 7th of February, 2024. 7th of February, 2024. So if I go down to, let's say M30, I'll be looking out for 7th of February, 2024, right? There is a breakup, there is a bullish engulfing on 7th of February, 2024. That's what I want to look for. This is December 2024. So I'm looking for February 2024 on M30. I hope TradingView will permit me to find 7th of February 2024 on this time frame. I'm seeing November 2024. Because after you notice the breaker block, you need to go down to smaller time frame to trade the reaction. What will happen on that breaker block? Is the price going to reject? If the price begins to reject from higher time frame H4, D1, you come down to the smaller time frame to look for entry. When the reaction have started, you saw the reaction on D1 bullish order block, bullish engulfing reaction away from the breaker block on higher time frame. Then you come down to the lower time frame to look for the entry. Actually, February 2024, please kindly be patient with me. That was when that move happened. I think we have it now. So the bullish engulfing on that particular day ended here. So after the bullish engulfing, all these were signs. This particular movement is a bullish engulfing. So that means our trading range starts from here. If this is the bullish engulfing, trading range starts from here and ends from here. That's the end of the trading range. Yeah, I think I will add all these other candles as a trading range because it went as high as this place. So, for all we know, This move started the bullish engulfing ended here. That means all this move was what happened after the bullish engulfing. All this one happened after the bullish engulfing. And we couldn't have entered any of this one. We want the price, if this is the trading range, we want the price to come back again down to the area where we left off from, either as a double bottom and give us a W sign, then we enter and we go up, or when it comes down, it shows us a sign and a reason to enter. If it drops down like this, and we have our trading range, this is where we are dealing with, then we look for a reason to enter this trade. Number one will not be the first push, which is this bullish engulfing. It's going to be too risky because price can actually go down to peak liquidity. We don't know. We want to see a move and a return, forming a neckline, forming a reason for us to enter on smaller time frame. This W pattern is very important. I remember I've talked a lot about this W pattern, especially this one that looks like this, looks like this, looks like this, and pick up to the top side. I've always talked about this W pattern. So you want to see it anytime you're expecting a reversal on smaller time frame. The push to the downside where we expected price to pick up from has happened. The move to the neckline has happened. The pullback to the W pattern has happened. Then the push to break that pattern has also happened. If you look closely and carefully, it has broken that line here. Then the moment that happens, we are good to go. We are good to go. Sometimes you have to wait for a pullback. Sometimes the pullback never happens. Because also, this forms what we actually call a mitigation block. This pattern now is called mitigation block. So, but don't worry about the name. I'm going to explain that a little bit more later. Because sometimes, you know, we said, if we have the move like this, we have the neckline form, we're supposed to have the second leg coming down, then this one going up, then we have a pullback before we move up again. Our entry is done. But sometimes we don't have it happen like that. We just have the reversal pattern form like this: 1, 2, then 3 here, then 4, we go a little bit pullback, then we continue moving. Usually, this is what we see. So when you are down in a lower time frame, your main interest after this has happened, bullish engulfing, a push, a pullback again to the bullish engulfing is your entry. Therefore, you look for a morning star, 1, 2, 3. This 3, the next candle is your entry. So when you make your entry here, your stop loss is under the entire swing on H4 or D1. Your stop loss is under the entire swing or H4 or D1. Because you know this entry is based off on breaker block on D1 or H4. So you have to allow enough room for your stop loss. How many pips is that? From what we have here, the pips is about 55 pips, or let's say 50 pips. So 50 pips is a very worthy pips to calculate, to use for a trade. Even in our challenge, most of those traders, they are using 50 pips. And it also, multiple things we begin to do recently, most of the traders are using 50 pips as the stop loss. So you notice that we have 50 pips and we have 1:9. That's the first take profit. Remember, I told you that the first take profit, when it happens that you are still okay, that's the end of that bullish engulfing, is the first take profit. But that is even choice where the entire move is. The entire move is not even the first neckline. The entire moves happen after the neckline break and retest on a higher time frame. You'll be able to see the entire move. But in this case, we have only the price move, the first move. And the first move for our calculation here, you notice the moment we have that entry, there was not even much pullback. What we have as our first and only move is the entry, then the push to the upside, take profits around this zone. 106 pips. Guys, you already have 106 pips. Look at the pips number now, 106 pips. I think at least this is a very nice move that you have caught, courtesy of that breaker block. Very nice move, right? So the swing will not work beyond here because this asset did not allow it to push through, right? All this other one is something totally different. Now remember, when you have a push from, let's say, a drop from this side to this side, you know, this is a resistance, this is a resistance. So it's a lot of issue to think and worry about. When there's a break and a pullback, a break and a pullback, a break and a pullback, and third time it happened, it broke down to the downside. You're supposed to exit now. If you don't exit, it will be stealing, telling you to exit, and you didn't exit all through this time, then it dropped down. So you see, even in trade management, you should have exited after all of this if it pushed beyond this. So, but of course, you have made 100 pips from this. So it didn't go further beyond 100 pips. So I will go back again to daily time frame to look for where we were and where we stopped. I've shown you what a breaker block is by simple, let me repeat again. I think I was drawing that thing from the weekly time frame. I've shown you what a breaker block is. I've shown you, I
dropped a message on the chat.
So we are going to take question at the end of this class because of our time. So please just follow. We are recording so we don't have breaking transmission. A breaker block is a situation, I'm repeating again for the last time. A breaker block is a situation whereby we have market dropping. 1, 2, 3. That is a sign of a swing to the, a trend to the downside. This candle, red candle responsible for this break of structure to the downside is important. When we mark that candle responsible, if the price, after going downwards on a downtrend, change its mind from continuing to the downtrend, but rather goes and violates the order block that caused that push. So we now say we have a failed order block. A failed order block is known as breaker block. When price comes back there, we expect to see price shoot to the upside. Now, we may not expect all these movements. It's going to be misleading, but at least we expect a reaction from that order block. Now, it's important for me to also say, when we were learning about head and shoulder pattern, we were told, and which I want to quickly remind you, that the size of the neckline down to the head is the same, should be the same as the expected size of the move when this move starts from here to this side. Therefore, it means that the move you are expecting after the breaker block is formed should be the same size from the breaker block to the lowest part down there. If that is the case, then the stop loss should not be as low as this. Rather, the stop loss should be halfway of that move. Because we do not expect this price, again, I repeat, we do not expect this price after showing us a bullish engulfing or a 3-candle pattern on higher time frame to go below that 3-candle pattern and still be going downward. Anything below that breaker block is no longer part of our trading on this breaker block. Therefore, even the stop loss can go down below. Why? Because we have seen a takeoff of this zone after the breaker block is formed. A takeoff of this zone forms our new swing of the zone. Therefore, the stop loss will be anything under the swing, that the new swing that was created. In that case, we now have 1:4 risk-reward ratio, which is now a perfect trade. I'm sure this is clear about breaker block. Continue to watch this video, rewind it, forward it, go back, go front, check the live market, and draw your inferences. Understand what breaker block is and master how to use it. The second institutional reference point, ladies and gentlemen, we're going to be talking about today is the mitigation block. The mitigation block is similar to the breaker block. As a matter of fact, instead of me to draw a new line, I will take the same line pattern of a breaker block to explain a mitigation block. Now, forgive me for not drawing the reverse, the reverse drawing, the reverse diagram of a breaker block, because I want you to focus on a bullish move. We are looking at futures trading. We are looking at bullish push to the top side. It's the same thing when we invert this entire market. If we invert this scale, it's the same thing for a bearish breaker block. So allow me to focus on only the bullish move so that you don't have so many things to think in your head when you are trying to understand what a breaker block or a mitigation block is. Now we have a situation where we have a diagram for a, what's it called now? A breaker block. Now, when a breaker block fails to create, when the structure of a breaker block fails to create this swing, you know, there's a move here, 1, a move here, 2, a move here. There's an order block that was here. Let me get that other block for you guys. So you see, there's another block that was here. A red candle that was supposed to break this price down below this low and come down. That candle could not bring this price down below. It stopped somewhere here. So when we have the situation whereby the what's it called now? The other block could not push this price too big. Could not push the price down to form a swing. So we now say it's a failed swing. Normally price was going up, down, came here up, supposed to go down, but it could not go down. It's a failed swing. If this failed swing happened, it's supposed to go down here, swing low. That's swing high, swing low. Then a pullback, then another swing low. But the failed swing, what we got. If there is a failed swing, push, failed swing, and the price now broke above the other block, the same way we see in breaker block, price now breaks and form this. When that happens, this place where the other block was formed, this place is known as mitigation block. Mitigation block because price could not come down to form a new swing. Rather, price went up and broke the block, came back to the block. Not every time to go so high like that, so sometimes to just go somewhere and stop there. Came back to the block. The most important aspect of this on the higher time frame is when we have a bullish engulfing. When we have a bullish engulfing, we can now say that the mitigation block is holding. The price has now formed a sign that this mitigation block will push. If that be the case, please remember we said from the neckline down to where it happened, sometimes you can bring it as low as this swing. But for the sake of safety, I want to leave it at where it stopped. Then take the same size and bring it up from where it picked up again. So if that be the case, then what we are expecting as our next push should not be that far. It should be something as move as this one. So we're expecting the price this time around, after forming the bullish other block, the bullish engulfing, to move as high as this. And if it's going to move as high as this on a higher time frame, we are having 131 pips. So you see, the mitigation block can give you a sign of 100 pips or more. Looking at what we see is the same way the breaker block was formed. But the only difference from the mitigation block and the breaker block is that the breaker block swing will come down, first of all, showing us a sign of continuation of swing. Push, then other block, then bearish, what's it called? BOS, break of structure to the downside. Break of structure to the downside, then market structure shift to the upside, MSS. Market structure shift to the upside, MSS here. Market structure shift to the upside, MSS here, then a pullback to give us a sign of bullish move, breaker block, then we go. And in that case, the breaker block gives us more number of push because the size from the neckline, which is the block itself, to the down part, the swing part, the same size from that part to the upside is the delivery. We call it distribution. The same size will give us the equivalent distribution, delivery size in pips or in movement, or movement, market momentum. So, but in the case of the mitigation block, this swing did not happen at all. Let's say even it's closer. It didn't even happen at all. So because it didn't happen at all, and then we have a failed swing, a push to the upside, a pull back to that same area, a bullish engulfing, gives us sign. Now remember that when we have this sign, we need to see this diagram. We need to see this design happen on daily or H4 time frame. If we see that and we see the bullish engulfing, we're expecting a move after the bullish engulfing is from a smaller time frame that will take us all the way from where that move is from. The stop loss is under that block because that block is the reason for that movement. We have 1:3.4 or almost 1:3.4. The first one gave us 1:4. The second one is given 1:3.4. Let's just call it 1:3. So I think the breaker block, based on what I've seen, gives us more opportunity in the market in the terms of market movement than the mitigation block. So with this being said, we can go to the market now and look for the mitigation block and try to find out how we can use or how it was used in the market. Look at a situation where we have on weekly time frame where this price was dropping down. Although I said we should go smaller time frame. Why am I using weekly time frame? I saw it here, so let me use it here. Then I go down again to D1 and 4 hours to look for it again. We have a situation here where the price was dropping down nicely to this zone, swing low. And we have a situation where the price go back up again to form a lower high. Here, the price failed to go down. The price failed to go down. It even failed to go back to the same height. So this place will be our lowest swing low. So this swing low actually supposed to go down below now. That's what we expect for the continuation swing. But rather, it couldn't form that swing. So we say we have a failed swing. After the swing high was formed, we have a failed swing to the downside, and the price went back up and broke that swing. The complete break of this swing here, we can say, yeah, a swing to the upside here. Then if that happens, then a pullback to this same block, this same candle, a pullback to this same block, this same candle responsible for that pullback to this same block, this same candle responsible for that pull to the downside becomes our entry, and that will be taking us all the way to the upside. That is the breaker block. Sorry, that is the mitigation block. Let me show you again what I'm saying. This block is responsible for taking this price down to swing low, but it failed to do so. So this block is now the mitigation block. It failed to take price down to swing low as expected. This is the first low. We expected another low downwards. It couldn't create it. So a failed swing. Now price went up and closed above here by this candle. It closed above. It pushed up to the highest point here. This is the highest point to the top side. It came back down here. When it came back down here and gave us a bullish engulfing here, that is our move. That move is expected to last us as long as from here to here. That means, let me show you, from this place down to this place. That's the expected move to give us the delivery like this. Do you notice that that's exactly the same delivery we got? So our next TP is expected to be here. That's the final TP destination. How many pips is that in weekly time frame? I just started. So how many pips in delivery? 530 pips. It's simply because we are using a higher time frame. I just want you to understand by diagram. If I go out of here and go to the diagram formation now, you will see what I'm saying. You will appreciate it better. So this is the first move to the downside. This is the move that went up. Then this is the move that went down. Then this is a move that broke across. Then this is a pullback within it. Then this is a push to the upside after everything is complete, the delivery. So if you come back to the candles, you now see in essence with all the wicks put together. So let me take all of this out. Let me go down to smaller time frame, H4. Let me show you example what a mitigation block is, so you get to know. Let me look for a mitigation block and show you sample, then we move ahead. Yeah, I think I found it. I found it. Perfect one. Perfect example. We have a situation here, price was falling downwards. We have a situation here, price was falling downward. Down, 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 down. Then we have a swing high here, then a swing low here. Then price move up. Then I think the highest point was here. Oh, shit. Permit me. Sorry. Sorry, please. I take it again. We have this move from here down to the bottom here. Price move up, not this one, but this one. That's the highest point price moved. Then price support, this red candle that happened here. I expected this candle to sponsor the move to the downside where we'll have the price go down like this. But this failed to happen. This swing failed to happen. So there is a failed swing here. Now price moved to the upside and broke through this swing up to this point. In fact, continue going up to this place. So that is, this swing did not happen, we'll bring it in. So that is a sign that we have a mitigation block here. So this red candle will be marked as our mitigation block, this red candle. After we see the W pattern form, that's where we mark the mitigation, please. We mark mitigation after W pattern has been formed. The first leg, the second leg, the mitigation formed, then we move. After this movement, you mark your mitigation block, then you allow the market to play out. When the market comes back to the mitigation area, we expect to see reaction. So this is the market coming back now, gradually. When the market drops down to the mitigation area, we expect to see the market pick up. Now, in this case, we didn't even see our entry. So which is also something to pay attention to. Now, I expected price to come in right here and get our entry. And if it gets our entry, sometimes this is higher time frame, remember? So I expect price to come down here and give us a sign of entry. That's this particular, this is called tweezer bottom. Tweezer bottom is enough. Then we'll go to smaller time frame and find the entry from smaller time frame. That's what I expected. But in this case, price did not even touch our mitigation block. So it's a bad example at the end of the day. If price will have to touch our mitigation block, from here, this tweezer bottom will now go down to smaller time frame, M15, to look for the entry on the next candle after. It's not even tweezer, it's something like bullish engulfing, but it's more of tweezer bottom. So we will go down to look for an entry at the lower time frame, M15. We will find it at M15. When we push it through, this looks like news. We take it all the way to the top. And we can drive it from that point. TP is here and a little bit above here. Because if we mark the expected take profit from here down to this zone, we will say, okay, if that is the expected move, we'll put it up here, from here again back here. So if we find our entry from here, we are going all the way to the top there. How many pips? 71 pips. So all this other one is Jara extra based on fundamentals news. So, but this setup failed. So let's look for another setup. Yeah, I think I found one. I found one. So we have a situation here in the market again now, where price was dropping down, where price dropped down to supports, a swing to form a swing low down from here down to this lowest part and push up to form a neckline. And we have a situation where there's a candle that was there supposed to drive this price down to a new swing low, but it failed to do so. The best it could go was here. That's the lowest part it could go. So this is a failed swing. Now we have a failed swing. When price is going back, we want to see if price can break above. Now price has broken above that failed swing. Now we want to see how far can price go upwards. It was here that we see last. So if we see this W pattern form, price break above that block that failed to give us the failed swing, that failed to give us the swing. If price break above that block that failed to give us that swing, then we can now begin to draw our zone for mitigation block. That will be the zone where we expect price to pick up from. Nicely. You see price went up to that zone, drop back again into the zone. That's the mitigation block. At this point, we will now begin to look for our entry. Very nice one. What we even notice here is that we have something that look like a morning star candle, 1, 2, 3 candle pattern, not enough, 1, 2, 3, 4. Then the next entry would have been this one. So this particular candle is our entry based on H4. So if we find our entry here, after all of these, 1, 2, 3, 4, that's when we look for entry. This candle gives us sign that this move, this block, this mitigation block is holding based on this rejection. So this candle here, we'll look for our entry at this candle. Of course, any pullback there will give us our entry. And our take profit will be the size of movement from this mitigation block to the down part. The same thing from this down part, the same thing now from the same level, sorry. Okay, the same level from that place to the upside again. So our take profit is around this zone that's here. Around this zone that's here. Then our stop loss is anything below that block. No. If we have our entry 1, 2, 3, our stop loss is under that entry here. 4 hours time frame. So this is what we have. That's the setup we have. So if we go back to lower time frame, we'll look for entry on this setup. And this setup is giving us how many pips? It's giving us how many pips? What's happening now? My mouse is not mousing. It's giving us around 60 to 70 pips. Not bad. Because we entered after here, we didn't see a good entry, right? But if we had seen a better entry from the very bottom here, and the stop loss is still around that zone there, it's not an issue. So because we know the entry is formed here, so probably on to, then we'll get our entry from this particular candle, put our stop loss close by. That will be giving us a much better pip value in terms of risk reward. So that will be giving us around 85 pips. If we had followed the price all the way up to get this extra one, we'll get around 118 pips. So that is the mitigation block. But you see, it's still lower than what we got from the breaker block. So let me come back and summarize mitigation block. What's the time? 8 o'clock. So we are just still at two of the institutional reference points, and our time is up. So the remaining ones, I'm going to rush them. I will explain them, but I'm going to explain them in a rush because I've taken time to lay the foundation. So the other ones will not be difficult for you to really grab. So you see, in summary or in revision, we have a move to the downside. We have a move to the downside. We have a push to the upside, a lower high. Then we have another block that was supposed to bring price downward to give us a breakup structure. but that other block was not able to push price down to the swing low. So we now have a failed swing. So this failed swing now, if the price, the problem is if, or the question there is if the price is able to push above and give us a market structure shift, having given us a failed swing, if that is the case, what we have there on that block is called a mitigation block. Look for a reason to enter it on the higher time frame H4, go to the lower time frame, and the delivery is the same size from the block down to this point, from this point back to the delivery. Then if we check from what we have now, the next one we should talk about is the liquidity void. Liquidity void is simply gaps. Another way for it is gaps. When the market creates gaps in the market, mostly it happens during the weekend. Whenever the price creates gaps in the market, gaps means void. And the price shifts away from that gap, especially breaking a structure. When a gap is formed, price shifts away from that gap, breaking a structure. Then whenever price comes back to that gap, it reacts to that gap. After filling the gap, it reacts to that gap. Let me show you what I mean. I'm trying to get my chart together. Just a moment. So my charts don't hide though. Anyway, that's his business. Let me pick another one. I want smaller time frame. H4. Aha. This is what I mean. Price formed a gap, but this is not a very good example. It's not a very good example, but it explains what a gap means or what a liquidity void means. Not a very good example. A very good example would have, after the gap, the price moved up to break a structure, a value structure. There is a structure here, but it's not a very strong structure. It's a weak one. After the gap was formed, I want to see that price broke a structure. Then after breaking the structure to the upside, I want to see price come back to fill that gap. Immediately after price fill that gap, I want to see a reason to enter. 1, 2, 3 candle pattern is okay. Bullish engulfing is okay. Then the next move I enter. The next move I enter after a pullback anywhere here is my entry. I'm going to measure the size of that move from the height where it was broken down to this point. I'm going to use that same move as my expected push from my entry to the take profit area. So that is void or gap. There is volume imbalance. There's also gap. Volume imbalance is also liquidity void. Gap, what we have here is just totally gap. Volume imbalance is where there is no candle, only wick. Only wick join the two prices together. Let me see if I can find volume imbalance somewhere and show you. Volume imbalance is very scarce, but gap usually happens during the weekend, after the weekend rather. Volume imbalance is where there are no candles. Maybe I should just draw it instead of wasting time. My time is up actually. You have a candle like this. Let's say, yeah, let me draw it like this. Yeah, we have a candle like this, and the candle has some volume. The candle has some wick like that. And let's say this candle is, color doesn't really matter. The color of the candle doesn't matter. So let me leave it as yellow. No, let it make sense. Let me leave it as green. We have a candle going up like this. Then we have also another candle. Another candle printed above on the way up. Also with wick as well. With wick as well. But the problem is that the This candle ended here, higher time frame, daily or weekly is better. The close of this candle ended here. The open of this second candle started here. It means there is a void. Usually this green candle supposed to come down and close below so that there will be no gap, there will be no void. So this is called volume imbalance if the price started above. So there's a volume imbalance between this close of green candle and this open of this green candle. This gap, this void or this space created here, when price goes up, whenever price come back here, price have a high tendency after coming back here, fill this gap, show you sign of going up, and they will go up massively. And the size of going up is the same size from this high down to this gap. It will give you the same size from here back to the move to the top side. So this is what we call the void, volume imbalance. Then there is also gap in itself, which I showed you earlier. In the case of gap, there is an absolute difference. Forget about this line, please. I don't know why this line is still showing here. There's an absolute difference. Take this one away. Between this candle and the next candle. Here. This candle ended here. This candle started here. There was no trading at all. Price was moving up, moving up, moving up, ended here on Friday. On Monday, jumped and went to start here. So there's a space created. So this is also liquidity void. We expect that price will come down from that high it went to, fill up this gap, show us a sign here, higher time frame, daily or 4 hours. Then we go to lower time frame based on that sign we see after the gap has been filled. Based on that sign, bullish engulfing, 3 candle pattern, we are moving all the way up to the upside. So the same size from that place down is the same size from here back to the upside. We are expecting the price to move. So from smaller time frame here, we'll pick our entry, then we'll put our stop loss under that structure that was formed here. Bullish engulfing, 4 hours, bullish engulfing. We'll put our stop loss under it and we take profit to the top side, over 100 pips plus. That's for liquidity void. The next institutional reference point that of ICT. Sorry, I have to go back to where I wrote it down. Oh. The next institutional reference point for ICT is fair value gap. Ladies and gentlemen, my time is up. I need to run very, very fast. Fair value gap is formed where you have 3 candle pattern. It could be any color candle pattern. The colors of the candle do not matter. What matters is the momentum push of the price. It's a 3 candle pattern. 1, 2, 3. Whereby the first candle, high of the first candle ended, then the high of the third candle started. There is a gap between the high of the first candle and the high of the third candle. This is what we call fair value gap. It's a 3 candle pattern whereby the high of the first candle, there's a gap between the high of the first candle and the low of the third candle. The second candle is inconsequential. This movement is this kind of arrangement is what we call fair value gap. And our expectation is no matter how far these candles go up, that we're expecting in the future, later on price will come back to this same area where a fair value gap was created and price will test it. Or price will enter it, encroach into that area to fill it up. A gap has been created, a gap has to be filled. When price come back to fill it up, we find a reason to enter that price, and that becomes our entry. If price could come back here and fill it up, we find a reason to enter, and that's our entry, fair value gap. Some of those fair value gap do not work. It's simply because the fair value gap is not a strong one. There are strong fair value gap, there are as well weak fair value gap. A strong fair value gap is formed where you have a bullish order block. A strong bullish fair value gap is formed where you have the presence of a bullish order block. The next thing I will explain right now is a bullish order block. But before I explain a bullish order block, let me see if I could find a fair value gap that is strong and that was formed after a bullish order block was created. I think I have found one. I will explain the bullish order block also with this same area. This is a 3-candle pattern. 1, 2, 3. 1, 2, 3 candle pattern, then a break of this structure happen even within the 3-candle pattern. 1, 2, 3. So forget about this red one now, please. I'm looking at 3. Any 3 candles together. Okay, this one cannot qualify because this one did not go lower. But this one qualify. 1, 2, 3. This is a 3-candle pattern formed here. This is an order, a fair value gap that has been formed. The fair value gap is the distance between the high of the first candle you have marked and the low of the 3rd candle. Going upward now is called bullish fair value gap. There's also bearish fair value gap. When you have been able to draw that gap and price move from the swing, move fair value gap up to this point. If price comes back into the fair value gap and show you a reason to move up, for me, that reason could be a pin bar. That reason could be rejections. This is a higher time frame weekly, remember. 1, 2, 3 rejection. I'm okay, I'll look for entry. Either here I look for my entry, or here I look for my entry, or even here I look for my entry. Once I see this pin bar completed on weekly time frame or daily time frame, usually I want to look for this fair value gap in higher time frame, weekly or daily or 4 hours. Most especially daily and 4 hours. If I see it, then I'll go down to a smaller time frame. I'll look for entry from here. If I look for entry from here, my target is this high that was created. When the fair value gap was forming, remember, it's going to create the move from the fair value gap itself. It's going to create a particular high after the fair value gap before the pullback. Therefore, when the pullback is over, we are going to expect the price to rise after the sign for entry is established. We look for our entry on smaller time frame. We're going to expect the price to rise all the way to this high. That is how to trade the fair value gap. The stop loss is after this entry has been established on higher time frame. Under the entries are stop loss. So you have entry, you have entry, you have stop loss, you have take profits. It's around 1:2 setup usually. So if you have that kind of setup confirmed for you on lower time frame, after it has been, the setup is clear from higher time frame, let's see what we expect from the entry all the way to the TP. It's around 290 pips, 300 pips, thereabout. It even went as high as 367 pips. So it's a very powerful tool, especially when there is an order block. What is order block? Order block is the next institutional reference point. Number what? Number 1, number 2, number 3, number 4, number 5. Number 5 institutional reference point is order block. Order block is the last candle that was formed before a break of market structure, a significant break of market structure. Price was going, let me delete so you see. I'm trying to be fast because my time is up now. I can't show so many examples. I'll just rush through it so you get it. Price was going downward neatly, going up, going down, forming lower highs, lower highs, lower highs, lower highs. All of a sudden from here, form another lower highs, came down here. It didn't go down again. From here, what we noticed was 3 powerful candles to the upside. And this move that happened, sometimes it could even have a red candle inside it. It doesn't matter. This move started from this green candle. This green candle is the lowest that started that move. Okay, I think, let's see, maybe the red candle was the lowest. Let's see. Sorry, I'm looking for which candle is the lowest because they seem to be like the same thing. Please, somebody answer. Is it the green that is the lowest or the red? Which one is the lowest?
They are on the same, is it support line?
Are you sure? Which one is the lowest?
I think the green.
The green is the lowest. If you stretch through, you will see the green is the lowest. So the green is a candle you are to mark. I intentionally want to mark the green because many people, when they draw order block, they draw the negative candle. time has shown time and time again that it is not an issue of color. It's an issue of where the move started from. The lowest place the move started from. That place is the order block, because that place will inform your decision for stop loss. So that candle responsible for the market structure shift that happened here. A market structure shift happened. This is a minor one. This is the major one that happened. It broke all two of them. It broke the minor one, broke the major one. The price was moving downward, formed a high here. It came down here. The move that eventually broke the market structure clean was this one. Some other people could decide to choose this particular candle as the order block because it also is part of the move that caused, in this particular structure is confusing right now, because this move went up, pull back, then finally will break to the other side here. And this red candle qualifies for a pullback because price went up and price came down below the candle. So this candle qualifies for a pullback. And this is why I do not choose this place as my order block, because we have a pullback here. If we have a pullback here, a valid pullback here, then there is no need choosing this as the order block. This one is no longer valid. The valid one, the valid order block is now this place. Assuming this red candle did not come below this high that was created and started from here. This red candle came and closed below the high, meaning that this move has a pullback. Then after that pullback, we now have a push to the upside. So this is a valid pullback. That is why I'm drawing this one as my order block. So if an order block, if a candle starts from here and break a structure, MSS, we call this MSS, market structure shift. MSS, market structure shift. When this candle breaks a structure, this candle that is responsible for that damage, according to Smith, my friend, the candle responsible for that damage is called the order block. So that's the definition of order block. Whenever price comes back to order block, we expect to see the price dump. We expect to see the price react after the price comes to order block. Now, in this case, I didn't see any reaction from here. Order block was not touched. I allow it to run. So sometimes you are lucky enough to catch the entry from here. After the push, it pulls back. You are lucky to catch the entry from here sometimes. Other times, it will not even touch, to go very, very far and come back and still respect that order block. Then you find the entry. Whichever way it goes, your entry is when price rejects the order block. Like here, there was a rejection of order block. Now, the reason this one didn't drop down low is because we have a fair value gap. So when an order block has a fair value gap after the creation of an order block, it means that place is very, very strong and highly valuable. Don't joke with the pullback that will come back to that place. That place is going to respond. It's going to serve as a springboard. That's the right place to bring that word. The work of an order block, the work of a fair value gap is to act as a springboard support to push price away up. Maybe you need to see me explaining that place. When you see an order block form, when you see a fair value gap form, they act as a springboard so that when price comes to it, they will push the price higher. That is their job. So here what simply happened was that fair value gap was responsible for this push to the upside. Then when the price came back to the order block again, this time around the order block was responsible for that push. The first rejection sign was this one. The second one, don't wait for it. Go down to lower time frame. This is a whole 1 week rejecting a particular order block. The second week, you look for an entry. If you do that, it's going to push you to the upside. In fact, this particular week where we saw this strong, powerful rejection, the following week is the week for you to enter a position. Any reason you see to enter that position, you should enter. If the price comes down lower, enter it. In fact, if you drag it to this other side and you see where the price comes down lower here, you have an entry. This entry, as small as it is on the weekly time frame, if you get that entry, what you are getting is 158 pips. So what you are looking for after these setups are formed on higher time frame, when you go down to lower time frame, you are looking for 100 pips. You are looking for 80 pips. You are looking for 120 pips. You are not looking for the entire move. If the price gives you the entire move, fine. Like in this case, if you are lucky enough to catch this particular move after this swing, let's say you were to catch this move, you go all the way up to 587 pips. So you are so lucky enough to get that push. So the idea is to let you know that there is a spring push that is highly likely to happen if an order block is formed, if a breaker block is formed, if a mitigation block is formed, if a fair value gap is formed together with an order block. Then the last but not the least is old highs and old lows. That's where I'm going to end this call.
Sir, please excuse. Do you say order block is the last candlestick responsible for the change of market structure?
Yes, that's what I say, and that's what it is, bro. Anytime there's a change of market structure, the last candle responsible for that push is called an order block. Let me give you a typical example here. I see where we have a change of market structure and with a combination of so many candles, so you don't think the colors of the candle matter. The candle responsible to this break of market structure, several of them can be marked as order block. The first one I will usually mark here is the daily time frame, is this one. This candle is the first one I will mark. There is an order block here. Did the price react? Oh yes, price reacted. How many pips? Downward, all the way from this place downward to this side. We were able to catch many pips after that reaction. From here down to this part, we were able to catch 127 pips. Another place again that we'll mark as order block will be this particular one here, who is responsible for the damage itself, although it didn't damage anything. No. If you go down here, this candle, this green candle, it did not break. It stopped here. Energy failed. So it's not a very strong order block because it stopped and there was a pullback. It stopped here and price went back, and before price broke completely. Well, anyway, even if we mark it, we go back, we'll see that the order block failed. The order block failed to hold the price. So from here, we dropped. We go back this way. We expect price to drop, but price did not drop. What did price do? This order block failed. This order block downward, stopped here, went up. There's a small rejection here. This rejection is based off on fair value gap. This guy and this guy. So there's a fair value gap after the order block. So price reacted to that fair value gap. There's an entry from here after this rejection down to this part, about 80 to 100 pips. But when after that happens, the price went back. Another fair value gap was formed here, which is now a PPR, which I will not talk about today. This is a fair value gap here. This is another fair value gap here. So a new fair value gap was formed here. Let me show you that fair value gap. This one. 1, 2, 3 was formed here. There's also another fair value gap again here. 1, 2, 3 candles. So we have 2 fair value gaps there. This is the main one that is really interesting. Then we have an order block on top of it. So price came down. Other block failed to hold. It closed above the other block here. If price closed above an order block, that makes this block a breaker block. So we extend. So this becomes situation of a breaker block. So we now have a situation of price going to the top, price falling down first of all, back here, order block, swing, failed order block. Our new high was created here. Came back to the failed order block. Anywhere here, we are looking for a reason to buy. There is no bullish engulfing. There's no morning star until this place we got a bullish engulfing. When we got the bullish engulfing, we went down to look for our entry. It's a W pattern entry from here. All the way, we go all the way up. And this W pattern entry coincides with also our fair value gap here. And so we had that push to the upwards up to this place. So if we mark from our order block down to this part, I'll mark from here to here, we'll see that it coincides the same. And then from here, we have a mitigation block form. This is a slow from this side. I'm not doing revision now. This is a low from this side, a high from this side. This is an order block that failed to come and continue to the downside. It stopped here. As it went up and pushed above, so we need to mark that other block that failed to create that swing. So it's a swing failure has been created here. That swing failure that has been created is also known as what? Mitigation block. So we match. We match forward, we wait for the price to come back to mitigation area. We see a bullish engulfing this daily time frame. The next candle is our entry. Although we need to look for a pullback. Anyway, if we go lower H4, we'll see this play out carefully. We'll find our entry after it forms. And if we didn't see our entry and we come down here, we have rejections here. If we enter, I think that would be a stop loss. But then the best place would have caught this was here to the top side. So there are different ways to do the entry. If you find the 4 hours time frame around this and you drop down to lower time frame, you might find an entry here and you are lucky. You take it to the upside. The last one I need to say very quickly before we go is old highs and old lows. I want to go back to NZD USD to find that. NZD USD. Old highs and old lows. The best place to catch those things are daily time frame, weekly time frame. You want to look for an old high, you want to look for an old low. Let me sweep up this everything. Remove 32 drawing. Yes. So an old high, an old low is where price has touched before in the time past. Usually, let's use the highs because it happens for the highs more number of the time. This is a place where price has touched before. And after price touched this place, price ran out from that place. So this running off of this high after touching it, they didn't do a W sign, they didn't do anything. It's a V pattern. An old high is usually a V pattern. It formed a V pattern and price ran away from that high. Running off to how many pips? Off all the way to how many pips? 470 pips, 500 pips. For how many days? It happened here on 28th December 2023. The high it created was on 22 April. December of a particular year to April of next year or the following year, the price was dropping. If price ever goes back to that high, ICT is saying that there's a tendency for this price to have a BSL, buy side liquidity. Grab liquidity because there are a lot of stop loss waiting here. There's a lot of orders waiting here. When people took this trade, they put their stop loss here and it was driving the market down. So when the price comes, it's going to leak over their stop loss and it's going to run off because they have a lot of money piled up there. And the year has not ended. This is September. So they won't let it run over. They are going to reject the price because they once entered the load and more people were loading, more people were loading, more people were loading, more people were loading, more people were loading. So many buyers are loaded here, institutional buyers. So many institutional buyers are loaded here on this swing high, and all these places where you have lower highs, more money was loaded here. That is the reason for all those drop in swing. So if the price managed to find its way back, some of those buys are still there. After a sweep of liquidity there, after a rejection there, we have the price dropping. I think I left the rejection block. So that is old highs. The same thing you do for old lows. Rejection block is when you have series of candles. When you have series of candles, is here also. Let me take this out so you can see what rejection block is. That's old and old lows. When you have series of candles, look at rejection. 1, 2, 3, 4. 3 candles. So the lowest candle that went down, the lowest candle that formed the swing, that candle, if there is a change of structure, if there is a market structure shift after the market picked up from that candle is regarded as rejection block because price will come back again to it and price will take it off to the upside. So you see there is a reaction from this side, a reaction from this side. So when you have series of candles rejecting a particular zone here, 1, 2, 3, something like that, especially when there is a break of structure. If you mark that candle in the future, price tends back to come back there, that place is called a rejection block. So later on in the future, you see price rejecting from that, reacting to that zone. I think this one is not a very good. Okay, look at the reaction from here to this side. But then it's not a really good example. We can find better examples somewhere else, where you have series of candles and then price rejecting from them. Coming back again to that side, maybe this is more of an old low, right? This one I'm seeing here is more of an old low because price come back here. This is more of an old low. It's not more of rejection block. Yeah, there are series of candles. I understand and I agree it's a rejection block, but also it's an old low. So there are two confirmations there, old low rejection block put together, price rejecting them. So when price come back there, we expect to see reaction. This is higher time frame daily. So, you know, we want to go down to lower time frame and see the way the price is rejecting on lower time frame in the future. Then we want to find our entry on smaller time frame, H4, H1, M30, M15. When we find a reason to buy anywhere from here, anywhere from all these disturbances, our stop losses under that reason to buy, and we are going all the way up. And you can see here, we had the movement after this rejection was completed from here. We had the movement to the upside of 100, 800 pips. Ladies and gentlemen, I wish I would just continue on and on and on, but my time is up. Today, we have successfully been able to take you through a detailed study, a detailed study of the 7 institutional reference points according to ICT. The 7 major institutional reference points according to ICT. How come I'm not seeing what I wrote? Okay, I choose another NZD USD. Unfortunately, I wrote them down and right now I can't find them again because I think I choose another broker on it. The 7 major institutional reference points of ICT. The first one we saw was breaker block. Then we saw mitigation block. Then we saw liquidity void. Then we saw fair value gap, order block, old highs and low, rejection blocks. So your assignment right now is to go and identify any of these 7. Take a screenshot of it and drop in the group. That is your assignment. Then for the rest of you on the call watching on YouTube, my time is up. I want to thank you for yours. Kindly click on the subscription button to join this channel to get subsequent videos and also to join our community where we drop our setups, our signals, our analysis, our updates as to all the various opportunities that we have going on in our community. Now, with that being said, it's also very important that I said that this class is a paid class. It's not a free class. We're only making it available for people on my YouTube channel for free. So if you are going to be joining us on this class, on this Zoom call, you have to follow the proper protocol. Make sure you are paying for the class and not being in the Zoom call for free. If you want to stay for free, always stay on the YouTube channel. It's completely free on the YouTube. But on this Zoom call is a paid session. I'm saying this because I see the Zoom call. I'm having some people who I know have not paid and they're always attending the Zoom call. Please just give us that respect, not joining our Zoom call. Stay on the YouTube. If you want to join on this Zoom call, as far as this 30 days VIP mentorship class is concerned, you have to pay for it. Yeah. So reach out to me to make the payment. Otherwise, just stay for the free version on the YouTube and join the free version. It's time for me to look at the question very quickly from the chat box. If you have not paid, I will not even read your question. I'm so sorry for that. I'm very rude to that point. I only read the question of those who have paid for the class and answer their queries. So if you have any challenges, if you have paid for this class and you're on the Zoom call, your challenge is here, you have any challenge for previous class, this particular lesson, or anything at all you want me to touch, please, this is the time for you to state your challenge that you have so I can be able to answer the challenge and I'll form the next topic based on the challenges that you have. So if you have any question, any challenge, any concern, any worry, this is the time to bring it up. I'm going to read it out and I'm going to form the next class based on your challenge and your inquiry or your request. So I'm seeing somebody say, sir, the situation where the market don't respect all of this, that's the fate of the trader. Yes, that is where risk management comes in. You must know where your stop loss will be. There are so many times all you do, all the setups, all the analysis, and markets come, the market misbehave. And if that happens, your stop loss will be there to help you. So many of the times, if you follow the professional analysis, technical, fundamental, and sentimental, if you follow all of these, so many of the times, out of 10, you might win 4 of the times. If you win 4 times out of 10, you are still a good trader, you are still profitable. Because your risk reward ratio, 1:2, 1:3, 1:4, as we have seen in cases of breaker block, you see they will guide you and make you profitable, not the analysis, not the trade, not the pair. Your risk management will always do that for you. Somebody is saying, somebody says, you said that you will take a trade today. Oh, you didn't remind me of time. I think what we needed to do today was to understand the institutional level. If there's going to be a trade to be taken, I can just give you an analysis for you to go and look for the entry. And probably, let me see if we have something on, we have something from NZD USD. From the monthly time frame of the NZD USD, I see that if I check again back to the line charts, I see that the price is forming kind of rejection on the monthly time frame here. So we have to do a top-down analysis if we want to take a trade. And in that regard, I can say we have a very nice opportunity because this is old low. An old low that was created in September 2022 have been revisited in December, and we are picking off away from that old low NZD USD. So it's an opportunity for us to buy the NZD USD. But then where are we buying from? How do we find our entry? This is very, very important as far as the monthly time frame is concerned. And if we are going to be buying this all the way to the top, the expectation of this monthly is this next level here. So, and the middle point of the monthly time frame will be this particular zone here. There are some of these zones that we can mark as important zones in the monthly time frame, which price is likely going to do some certain things when we get there. So I just want to mark 3 areas there. Just 3 is enough. Instead of marking this, I think I should mark this one because it has 2 areas. It has this, it has this. So I think I will prefer to mark this one. So that is the monthly mapping. So I will go down to the weekly mapping where I have the price dropping from here to here. I'm more interested about that. Then I'll look for where we have a repetition. This one here is coinciding with nothing. This one is coinciding with nothing. So I don't really care about any of them. I just want to see how price will make a W sign and we'll start moving from the weekly time frame on the NZD USD. So there's nothing much for me to mark here. I didn't see any reason. I didn't see anything to mark, except maybe I'll say caution has to be played on this area because there is a resistance level here. And also I'll make this number 4 so that I'll pay attention to that zone when we get to that place. And also probably I can say also that caution has to be played in this area because it's also coinciding with what we have close by here. So I want to pay attention to what is happening here. This place is going to be a troublesome area for the resistance level 1 to 3 on the weekly time frame. If we go down, dropping down to daily time frame, I'm looking for the most recent move in the daily time frame here. Forget about what's happening in that resistance area. Our main concern is where the price is around this zone here on the daily time frame. This is a monthly zone that price has left the monthly zone, and we are looking for how that price is going to form a W sign and a sign of takeoff for us to go to the upside. Right now, where price is a place of resistance, so we can't even be looking for entry at this area here because there's a resistance here on the daily time frame. If you carry the candle, the line here to mark this area of resistance, we want to see what price will do with this resistance level on a daily time frame. If you mark and go closely and change this guide to something like 3, it will give us a more sense of belonging about what is happening here. So we have a resistance level of price at higher time frame, daily time frame on the daily chart of the line chart. If we go back to candles, we'll be able to see what exactly it is that we are dealing with. We are dealing with a particular high here. The price have failed to close above this high on the daily time frame. If we drop down to 4 hours time frame, we will see clearly that that side is a rejection of the monthly time frame, and it has closed nicely to the upside, forming the W pattern 1, 2, 3, 4. And if we look downward here, we have a double bottom sign, and also we have a kind of breaker block pattern that has been formed here based off on this movement. 1, 2, let me show you the movement again. 1 to this point, 2 to this point, 3 to this point. Not breaker block now. I think it should be the fourth move is here to the upside. Then the next move should come down to this level of this candle. Anywhere here is our entry. So, but then let me see what kind of structure is this. Is it a breaker block or is it a mitigation block? Let me see. So somebody should answer my question. Is it going to be a breaker block or a mitigation block based off on this week we are seeing here? Is this regarded as breaker block? It's going to be it's already a breaker block already. It's a breaker block because we have a candle broke below that it's a break of structure. Although even if the break of structure is not a full candle close, but then it's pushed down. So the new swing has been created. So there is no failed swing. A new swing has been created. Therefore, this whole candle is our breaker block candle. So that means, let me differentiate that so you see clearly. This candle becomes the breaker block. So anywhere from here is a very good entry situation. Anywhere from here is a very good entry situation. So we are going to wait. It went all the way to this top here. So we are going to wait for a price to come down to the entry. Anywhere from here to is the entry. 50% of that breaker block is the best place to look for our entry at around 0.5613. If we bring it down and down, we have nothing to do other than just to wait for the price. If we wait for the price, NZD, USD, if we wait longer and longer enough, we would be able to find our entry around 5615. You know, you want to see a reason to start buying on the smaller time frame. H4 is good, H1 is good, M30 is good, M15 is good, but you want to see a reason. Bullish engulfing, Morningstar candle, always remember, don't forget, rejection, pin bar, any one of them. The breaker block zone is a very good zone where we can look for the entry because we will not expect the price to come down. If anything brings the price down below 0.558, then it don't cast. It don't cast. It has gone. Otilo Asiwaju is no longer a bullish push. It's now a call for a continuation bearish candle on the monthly time frame. And that means that we are going down. So therefore, our stop loss monthly time frame is 0.5583. Is our original stop loss. Then our first take profit will be around this zone here, 0.5618. Then the second take profit is the next high, which is actually this place here, 0.5835. It's capable of giving us that push, that drive. Although I saw something here which the market will always deal with. All these places a free move to the top side because we already have a break of a market structure shift of this particular zone here. We have already a market structure shift here. If I change it back to line and bring this back to 1, I'll be able to say clearly this is a market structure shift. And then what we have is like this. And then we expect that price will now move all the way from here now to this. This is not even any concern to us because we see price going far above it. This will be a little bit of concern, but this is all liquidity. Price will use this as liquidity and give us all the way to the next resistance turn support on the weekly time frame. Anywhere around here is our take profit. But then this is 1:6 risk reward ratio. So I think it's a very good trade and it's a worthy one to be taken at that. So you asking for a trade, I think I've given you this. So, and you can see when I was drawing all of this analysis, I used all that we have learned from the beginning of the class up until this point to look for this trade and give to you. So you have to wait now, be patient enough to wait to get a reason to buy from 0.56. If you don't see a reason to buy, don't jump in. Well, some traders do buy limits. Even me too, I copy traders who do buy limits. I accept their trade and their order. They are telling me that if price comes here, there will be a reason to buy. There is a mitigation, there is a breaker block here, which is one of the reasons to buy. There is an old low here that's peaked already. There is a monthly support zone here. Then if you look carefully, I don't know, maybe if we can have it on the daily time frame, there is something we call BPR, balanced price range, that will be formed probably tomorrow, which is candle pattern 1, 2, 3, but it's not really clear 1, 2, 3. It didn't really form the way we wanted it. Let's see on H4, it didn't form well. Anyway, there's no BPR, guys. I didn't see anything like that. But then we see something also that looks like head and shoulder inverted. If the move started from here, no, that's not really good. If the move started from here, then the first shoulder would be, if the move started from here, upside, the first shoulder is this one. The second, the neckline will be here. The third one is here. The break of the head happened here. Then the second shoulder formed here. So at the second shoulder, if we see a reason to buy, we are buying at the second shoulder and we are going all the way up. If we are using based on head and shoulder pattern, you know, we already learned that the same size from the neckline So I think we have to call it a day here. We have come to the end of the class. So see you tomorrow again by the same time. My time is up. We spent 2 hours instead of 1 hour. So please, let's go and mark the 7 institutional reference points. Find it